Going live, going live. All right, we're on the air. We had a few technical difficulties there, everyone, but at long last, we have David Bassanese, the chief economist from BetaShares, joining me. David, I think the last time we chatted at length, I was in your office or in the boardroom at BetaShares. That was, I think, maybe 2 years ago, maybe something like that, maybe even 3. I don't know. It was a while. And we had a very, very different economic environment than we do now. And so I've got a number of topics I want to ask you about today. I've got a few questions from some of my clients as well. But I thought we might just kick off by I'll give you the air, and you can just give us a quick rundown on what's going on out there. Why is it so crazy?
Well, look, I shouldn't laugh. Obviously, it's a pretty serious situation with the virus, and look, you know, we're basically at the moment globally we're in a depression imposed by governments due to the coronavirus, the lockdowns. Now so that's the bad news. The good news is, you know, if the social distancing restrictions we've done seem to be flattening the curve. The rate of new virus infections globally has come off. It's still uncomfortably high in the United States, it's to be said. So we're in this position now where restrictions are slowly lifting, and we're just, you know, in that delicate balancing act of how fast do we lift restrictions versus what is the risk of a second wave. You know, historically with these influenzas, typically you get second waves. So we're really that sort of inflection point where we are lifting restrictions. Things are gradually getting better, but I think, you know, unfortunately, I don't think they're going to get a better, you know, back to normal anytime soon. So that's the sort of, so I think, you know, we're moving from depression to still like recession, I guess, you know, serious recessionary conditions. So where activity generally is still well below normal levels for a while longer, I think.
And that's I want to pause on that for a moment. That word you just used, depression, it's a word I've been using in a lot of the client updates that I send out to my clients, because I think, you know, oddly enough, there's not been an acknowledgement yet that we're likely in a depression at the moment, and moving then into a recession. Like, we're not just going to immediately go from depression to recovery. We're going to have to transition through that. So I'm really pleased that you as an economist are using the word depression, because just yesterday on Sydney Morning Herald, there was a caption that was talking about, you know, recession fears loom or something like that. I'm like, guys, recession, we're beyond that. We're in a depression. So what do you think normal is going to sort of look like, say, and how long? So 2 questions. What's normal going to look like when we get through this? And then maybe how long do you think that's going to take?
Well, I mean, again, the good news about this is people say this is like a natural disaster, you know, so it's like it's a massive shock that's hit us right up front. So typically with recessions and even depressions, they start off gradually and they get worse and worse and worse, and then you hit a bottom. Whereas this time, as I sort of said, we've been hit, you know, the worst of it is like right up front, and then things gradually improve. So what will normal look like? I mean, and again, the nature of this is because it's been driven by the virus. If we can get a vaccine, say within 12 months, as the experts suggest, then this is a source of risk for, you know, markets will go away. So we do know there is light at the end of the tunnel, hoping that, you know, on the view that we can get a vaccine and or, you know, a less pleasing way of getting there would be through, you know, basically having waves of this virus and eventually herd immunity being built up. Therefore, you know, we can withstand, you know, moving around again, because we're not going to get sort of inundating our healthcare system. So look, so as I said, the reality is at the moment, the unemployment rate in Australia, you know, let's boil it down to something that people can kind of focus on, you know, a number of people understand. So before the virus, it was 5.2%. The RBA, and I think this is right, it's going to hit probably 10% by June. It's now around about 6%. We just got a labour market report yesterday. It had almost 600,000 jobs lost, but the unemployment rate remarkably only went up to about 6%, because a lot of people basically define themselves as not in the labour force. So that was that. But I mean, I think it will eventually go up. But this time next year, if all goes well, it'll probably come back down to say 7. But that's still like higher than we would like. But again, one of the struggles will be that even if there isn't a second wave, even if we lift restrictions until such time as a vaccine has come on the scene, businesses and consumers are likely to remain quite cautious in their spending, and particularly business investment plans will be cut back substantially given this uncertainty. So that's what's really going to restrict the recovery, even if we don't get a second wave. Just that lingering uncertainty, unfortunately.
Okay. And with regard to the unemployment rate, you just were talking about that. We just had numbers published on our unemployment rate. It was yesterday or the day before.
Yeah.
I've lost track of days. It's Groundhog Day every day at the moment. But that captured, I suppose, the tail end of March and all of April, I believe. Did it not? Or was it only part
of the April reading? Yeah.
Okay. And so do you think that it's going to get worse from here on? Is it going to continue to climb?
In terms of employment loss, no. I mean, so we had almost 600,000 jobs lost in the month of April, which is unbelievable. Like, it's magnitudes more than, again, that's because of the shutdowns. We basically shut down the whole economy, well, 3/4 of the economy, or maybe not 3/4 of the economy, but a big chunk of the services sector, effectively shut down. So we won't, we're not going to lose 600,000 jobs every month going forward, but we're probably still going to lose, 30, 40, 50,000 jobs going forward over the next couple of months, and then that bottom is out, and then it will start to recover. I mean, that's the thing; it's going to take a while for those 600 jobs to come back to come back. So that's why I said, like, this recession is one where it starts off really bad and then gradually recovers, but even recovery conditions are still, like in a normal recession. We go from a depression to a normal recession, even though the rate of change is improving.
And with regard to, so you mentioned a couple of sectors there being retail and I suppose the broad economy right now is under a lot of pressure. And what sectors of the economy are still sort of holding us up? That's the first question that I've got for you. Is what is still showing some strength? Where are we going to rely on to see positive economic growth?
Well, look, the resources sector has actually held up pretty well. So resource exports to China. I mean, China, again, the good news out of this is that China at least seemed to get on top of the virus pretty quickly. It shut down its economy before anyone else. It's recovered. A lot of the indicators in China are now pointing up. So again, assuming China doesn't get a second wave, it can get as close to normal as we might hope over the next few months. But we're seeing resource exports, iron ore prices still going along pretty, iron ore prices holding up, and iron ore volumes still, pretty solid going into China. So the resources sector are certainly holding up. I mean, look, outside of this, I mean, the areas that have been most affected are restaurants, retailing, accommodation, cafes, that sort of the services sector, client facing, where human interaction is required basically on a major scale, mass scale human interaction type activities have been most negatively affected. But most of us, in the finance sector, for example, we're all still working. We're kind of working from home. Okay, we're working in different ways. But, so it's really most of the economy is still operating, but there's a chunk of the economy that's basically shut down completely. So that's why, overall, the net effect is still pretty bad, because many areas it's still operating at 80 to 90% capacity. In some areas it's at 0. So it's a massive imbalance at the moment. So just going back to your point, I mean, it's really most sectors apart from those, as I said, large-scale client-facing areas like retailing, tourism, accommodation, cafes, restaurants, are still operating, albeit we're working from home. The problem is you do get second-round effects because of vast slab of people have lost their jobs. They're not then going to use various services that we rely on. So you're getting that second-round effect coming through at the moment.
And with that second round effect, I guess I want to have a discussion or conversation about the banks and what this might look like in, say, 3-6 months, because we know that a lot of people have asked for repayment pauses, and
Yeah.
they're sort of saying we want to have a break from our mortgage, probably because of either reduced working hours, possibly having lost a job, something like that. Do you think we might get, say, 3 or 4 months from now, when the economy sort of, let's say, restarts in quotes, and that what will that second wave start to look like? When will we sort of know, I guess, that we're over some sort of hurdle where we're not going to see a lingering effect of people who have lost their job, put a mortgage on hold, didn't get their job back, and now have to go and sell or go into foreclosure, that sort of thing. So maybe if you could just speak to that, what your thoughts are on that.
Yeah, look, it's going to be one of those difficult transition points. I mean, at what point do you call time on companies and households that can't service their debts? I mean, again, in the good times, many people probably took on very large mortgages that were a big chunk of their income, that were serviceable provided they kept their jobs. Now, maybe they're not going to get their jobs back again, or they'll get a job, at a reduced salary. And so they're not going to be able to, live like they used to, or service the debts that they used to. So that, at the end of the day, banks are probably going to, we will see an increase in default rates. I mean, it is a recession. We saw it in the GFC. We saw it in the early 1990s, although back in the early the last, I guess, official recession we had was in the early 1990s, whereas consumer leverage back those days wasn't as extensive as it is today. Look, so at the moment, we're in this period where banks are being forgiving. But again, the longer this drags out, and will drag out, and even with recovery, the unemployment rate's going to be higher than it was. I think we will see, default rates picking up. And, banks, I don't know the answer as to, how high they will go or where banks draw the line. But I mean, if, in 6 months' time, if a worker is still struggling to find employment, then the banks are probably going to have to draw a line in terms of how long they can extend those repayment holidays. And it's the same for business. I mean, even not only us globally. I mean, central banks are bending over backwards to provide financing to banks so they can keep companies, turning over their being able to borrow to go get through this period of not being in business. But again, there comes a point where the economy reopens, where some businesses just don't come back, and you've got to pull the plug on the financing. So you'll see default rates in the corporate sector go up as well, and that's where we transition from this, I guess, Team Australia depression to a bad recession, and some companies and households will be forced to adjust.
Do you think, I know there's a lot of talk, because I obviously pay a lot of attention to what's going on in the U.S., given that they're, driving a lot of the stuff that goes on around the world, both in financial markets and, of course, economic-wise. And they're talking about the narrative over there around jobs is that we may very well see a lot of permanent job loss in a variety of sectors. Are there any sort of sectors, I suppose, in Australia that you're looking at, or you're considering, that we may see that permanent job loss that just are not going to come back, or going to be at half capacity, or something along those lines?
Yeah, well, I mean, I think in the retailing sector, I mean, retailing was obviously under a lot of pressure even before the virus, with the online competition, just consumers also. I mean, Australia, before the virus hit, consumer spending had been slowing down. We basically, household debt levels were quite high, and it seemed that consumers had reached a limit in their ability to want to spend, much beyond their income. And Australia's also had a pretty low household income for a while. Wages growth has been quite low. So we actually had a pretty subdued economy before the virus hit. So I think in areas like retailing, which were probably struggling before this, now they've been, pushed out of business. And, I think many businesses will basically, think again about whether they really want, now this is I guess, a clean break. As that acceleration toward online shopping. So a lot of our retail, the retailing area, retail property, I think there's going to be, ongoing major shakeout in those areas. That's the most obvious one. I mean, things like restaurants, pubs, these sort of things. I mean, I think people will go back to them pretty quickly. So I don't think those, that they will come back. I mean, interesting. You think about. I do take with a grain of salt some ideas that life will never be the same again, because think about anyone who's looked at the 1918 pandemic, for example, where they actually did have shutdowns and whatnot as well. Then we had the Roaring '20s, so people came back, and they were going to speakeasies, I guess, at the time. But I mean, certainly, people went back to social engagement. And I think so. We're social creatures, so we definitely go back to those sort of activities. But so the one I could point to is obviously bricks and mortar traditional retailing. Many businesses will I guess think again about whether they really should be reopening. Is this the time to make a clean break of that as a business?
Yeah, well, I agree with most of those sentiments. In particular, I'm very pleased that you said just a moment ago that the economy was already slowing prior to COVID coming in, and it's something I've been saying to my own clients for a number of months now. Is that actually the data showing that we're slowing, and it just so happens that we had this black swan, and that's what I think the COVID thing really was, is something that you could not have predicted, and it's really just accelerated to the downside and everything, and made it even worse than it probably would have otherwise been.
Yeah, I wish I mean, the thing is, I mean, looking back at it now, I mean, again, as an economist, I'm not a medical expert. So, I mean, we had the SARS outbreak in '03, which was pretty well contained within Asia, and it didn't cause a global recession. We had the swine flu outbreak in '09, which led to a few tremors at the time. But again, it ended up being an influenza with a relatively low death rate. So it was a bad flu, effectively. This one turns out to be more like 1918. So, with hindsight, I'm thinking personally from an investment point of view as an economist, I would love to have, if we'd known that the lockdowns that we saw in China starting in January were going to actually be the reality in September. Sorry, in Europe and the US, no one imagined that what China did, that Europe and the US would be doing within a few weeks, and that was a real shock, I think. But you're right. Even before then, no one anticipated this happening in China, before, mid-January. But there was, I guess, a period where some people could have, if you knew a lot about it, you thought, well, there was a big risk that this could spiral out of control, as it has. But unfortunately, as economists, we're not experts in diseases, and so this is one of those black swan events, as you say, that really snuck up on us and hit us over the head, unfortunately.
I think it snuck up on a few people. I think President Trump in the United States were thinking we just shut our borders down, stop people coming in, and we'll be right. But it's now probably one of the most affected countries in the world in terms of deaths and new cases and everything else. But cool. Well, I'm gonna come back to corporate earnings in a second, but I'm sure that everyone is waiting for it. And I've had some good questions from clients, and so one of my clients, David Cook, is asking, and I'm sure many of them will want to know what's going to happen to house prices. Everybody in Australia is passionate about their housing. So how do you see this situation affecting house prices and that whole conversation?
Well, I mean, it's fair to say that it's not a positive for house prices. So, I mean, we did have a gain in house prices in Sydney and Melbourne over the last few years on the back of the RBA cutting rates. So again, the backdrop is that house prices were going up, and the RBA was actually counting on house prices continuing to go up to create a wealth effect, to get sluggish consumer spending moving again. Now unemployment hitting 10%, incomes growth is still quite weak. Interest rates are obviously much lower, but net, I think house prices will pull back. I don't see more than I don't see a massive decline, because I don't think we'll see. Massive decline, I mean more than a 20% decline, but I think a 5 to 10% peeling back in national house prices over the next 3 to 6 months is reasonable, and simply because people won't be going to auctions bidding over the odds for properties. They'll be looking for bargains. People won't be moving if they don't have to. There'll be the upgrade market won't be there, so it'll be a period of subdued price, I think house price declines, but I think provided we don't get a lot of forced selling, And again, this comes back to this debate. In 3 to 6 months' time, if banks are, saying, we're going to call in your loan, you've got to sell your house, then that's where things can get a bit more, more negative. But I think that will be moderate. Again, looking at the evidence from the RBA in terms of the percent of households that are really over their heads, it's still pretty small. So most households can comfortably service their mortgage, and certainly, most in employment can comfortably service their mortgage. So there will be an increase in default rates. There will be a decline in house prices, but I don't think the increase in that forced selling will be enough to sort of cause a more than, say, a 15% decline in prices. But definitely, around that area, 5-10% decline, you've got to anticipate over the next. We are in recession, and that's what happens.
Mm-hmm, mm-hmm. And just, I suppose, a corollary of that is a lot of the banks have started to already, cut dividends, indicate their provisioning now for larger losses, and they're sort of anticipating that we're going to have, a problem in the housing sector. How do you think? I mean, if this really prolongs, are we going to see any real pressure on our banking system and the Aussie banks?
No, I mean, I think our banks, they've actually raised their capital levels quite substantially over the last few years, and I guess now fortuitously having done that, I mean, so the regulators were very keen to make our banks unquestionably strong by global standards. So in fact, if you look at it, many of our banks have very high capital ratios now by global standards. So I think, again, if you go back to the GFC, for a brief moment in time, people did fear bank solvency, that one of our banks could go under. I think that's very unlikely now. So I think bank solvency is pretty much, not never say never, but I mean, I think it's a very, very low risk that a major bank would have any solvency concerns. But they'll obviously have an earnings concern. Earnings will go down. They've cut their dividends. I don't think they'll remove their dividends completely, because, I mean, it's still an important source of income. I don't think they'll be under political pressure, for example, by either the government or the regulators to basically stop paying dividends. Though they will cut them back somewhat, because that is also an important source of income for many people, relying on dividends. So removing them completely, it's probably better that, should they need to, raise capital, they'll go and issue more equity, rather than, cut back on dividends or remove dividends completely. So for those relying on dividends, I think you'll still get some, but not as much as you're getting. Those relying on bank hybrids is another way people get income from banks. I think that's pretty much will hold up pretty well. Though I guess the price of hybrids itself also vary with bank credit spreads, because it's effectively a form of bond. So we saw a period where credit spreads in Australia, the value of bonds, corporate bonds and hybrids declined, so credit spreads widened. So the price of hybrids came off, but now they've come back again, almost back to where they were. But in the meanwhile, if you're a long-term holder of hybrids, for example, you will get that income that they offer. I think is pretty reliable, and more so than the dividends at the moment. So again, that's one of the benefits of investing in debt and hybrids over shares, because the dividends can be cut. It's a bit more discretionary.
And of course, Beta Shares, this is a good chance to get a little Beta Shares plug in there, has a really good hybrid fund called HBRD is the ticker symbol. It's a fund I actually use from time to time in my business. And you're right, it has held up pretty well. I have noticed that.
Yeah. Yeah.
No, go ahead.
I was just going to say, yeah. I mean, it's an easy, convenient way to get to invest in hybrids. I mean, we've obviously from a retail investor, it hasn't been easy to invest in hybrids directly. You can buy a hybrid, but then you're sort of stuck with a lot of corporate, a lot of risk in one bank. Whereas if you invest in a hybrid fund, you're getting that diversification across many different players, and you can buy it and sell it on the ASX. So yeah, you're right. It's been quite a popular fund, and offering relatively good income with downside protection when equities sell off, or it doesn't sell off as much when equities sell off. So it's good intermediate between cash, bonds, and bank shares at the other end of the risk spectrum.
I totally agree. Totally agree. And I want to circle back in a moment to earnings and then to interest rates. But first, I want to ask a question that's just popped in from one of my clients, Judy. And just again on the strategy conversation, she's asking, are there or what strategies can we use in these sorts of times to diversify, and just maybe some thoughts on how to protect capital, I guess, and then maybe get some diversification as well.
Yeah, look, I guess I should share with you my view on the share market at this point. As I said, we have had a share market decline. It depends how tactical you want to be. Like, so if you're a tactical investor, you have a 3 to 6 month sort of time frame, and you're worried about the market selling off. I actually think we are still in a bear market. I think there's a pretty good chance that we'll retest the lows and possibly go lower. So I am still short-term cautious on the market. So in that sense, there are different ways. Obviously, you can go defensive and invest in bonds or hybrids that will hold up relatively better than shares. We have a fund, and again, you've got to use it carefully, but we have a bear fund, for example, which basically goes up when the market goes down. And so people are using that to hedge some of their portfolio. So if you hold a lot of shares you've held for a long time, you don't want to sell them and realise capital gains tax, but at the same time, you are fearful of a market decline. And what we're seeing is some people are buying the bear fund, effectively hedging their position. Now, that means that if the market does go down, yes, on paper, the value of your shares goes down, but that's offset by the returns on the bear fund going up, assuming then you sell bear fund and take your profit. But by the same token, if the market goes up, then yeah, the paper value of your shares will go up, but what you get on the bear fund will go down and will offset that. So you are effectively going into cash by buying the bear fund, to offset some of your shares. So that's one way people are using it. Look, so diversification. At the end of the day, you can go. There's a risk spectrum: cash, bonds, equities, and so at the moment, if you are worried, you obviously not be throwing a lot of money in the share market at the moment and being somewhat more cautiously invested. I think areas that have held up globally, I think will hold up again. If equity markets sell off, they'll probably weaken as well, but not as much as the overall market. So things like US technology has been doing quite well, like the FANG stocks. So it's funnily enough that one of the areas least affected by the shutdowns has been the US tech sector, the Googles, the Amazons, the Facebooks, because people are, doing more online. And so we've seen in the United States, the NASDAQ 100 index, again, we have an ETF that tracks that. That's actually held up relatively well. But again, if the markets do have another correction downwards, the NASDAQ will come off as well, don't get me wrong, but I think it will probably not fall by as much. And importantly, when we do come out of this, I think the tech sector will be even in a stronger position, and actually again continue to outperform. So that's one that I think getting that global diversification through US technology, and a more broad one is quality. So quality companies is a factor. You can invest globally in companies with a high return on equity. And again, we have a fund. There's other funds out there, but that's called a quality fund. QLTY is the index. And that just gives you broad exposure to the top global companies with the highest return on equity. So, very strong balance sheet, very strong profitability. So there's a few areas to get diversification globally that I think, will hold up relatively better and actually come out the other side pretty nicely as well. Resources in the Australian market, again, I think China's holding up. Resource exports are holding up. So I think the resources sector, again, can hold up relatively better than other sectors in the Australian market. So that's another thought within the equity market.
Okay, no, some good tips there, and obviously you pinged about 4 or 5 different beta shares funds that give you that diversification, and the ticker symbols are in there for anyone that's interested. And of course, I can help with that too, as a financial advisor to many people. If you're interested in that stuff, I can help you guys with doing business with beta shares. Now, I wanted to talk about. Actually, let's talk about the Aussie dollar, because some of those funds you mentioned, like the NASDAQ fund, Obviously, if you just wanted to get S&P exposure, you guys have a fund to do that. And I know you have a lot of also specialist funds, healthcare, miners. There's a whole stack of them. I can't think of them all off the top of my head, but many of them are hedged, which means that you're trying to hedge against any major currency risk. But let's talk about the little old Aussie battler, which has been beat up a little bit here. Where do you see it sort of trading and going maybe in the next 3, 6, and 9 months?
Look, the Aussie's been quite highly correlated with global equity markets really since the COVID crisis began. So again, when the equity markets sold off over March and February, the Aussie dollar fell sub 60 cents. I'm sure as many of your listeners know. Now it's rebounded to the mid 60-cent range. Now again, I'm short run negative on the market. I think the equity market is probably going to roll over again and potentially retest its low. So on that basis, I think the Aussie will weaken again. And I think it could weaken back below 60 cents, maybe to the mid to high 50-cent range, would be my view over the next 3 to 6 months. Beyond that, then some recovery back to sort of where we are now, assuming a return to normality. So like a long run fair value for the Aussie is around about 65 cents if you look at different sort of valuation criteria. But that's sort of my scenario at the moment. I wouldn't be a buyer of it here. I think it's more likely to weaken again. But mid to high 50-cent range, that's a good, pretty good starting to look good value again.
Okay. And do you think that we might see the next, if we don't get that share market, sell off again, maybe in the next week or two, I think we have a GDP number coming out first week of June. I want to say the 5th, but I may have the date wrong. Is that right? Do you know when the Australian GDP numbers get announced?
Not off the top of my head, but it'll be for the Q1, the Q1 GDP, yeah.
And I think it's early June. I think it's the first week of June. Do you have any sort of feeling as to, I say to my clients, I don't like to feel anything. I want data. But do you have any sort of prediction on where that number might come in?
Look, it's going to be a negative. I mean, Q1 is actually, a lot of it predates the virus. So actually Q1 probably will actually hold up relatively well. It'll probably be down. It'll be a negative, but it'll be a small negative. So maybe down 1% or something like that, 1 to 2%. But then in Q2, Q2 is the big one. That'll be the big nasty one. So the June quarter, where that could be down like 8 to 10% or so, quite a significant detraction. So the GDP number coming out almost for the Q1 it's because it kind of largely predates the shutdowns, which really took effect in March. So we had 2 months without shutdowns. But again, as you point out, our economy wasn't great before the virus, so it was fairly subdued. And even before the virus, we had the bushfires, so we had things that had hurt the economy already, and consumer spending was quite weak. So it's going to be a subdued number, but the Q2 one, the June quarter one that we get, 3 months or so later, it's going to be even worse.
Yeah, I agree.
Again, I shouldn't lie. It's quite serious. It's just, I guess as an economist, these are numbers like, we've never seen before in our life. It's just almost unbelievable, the numbers that we're getting. And it does, and again, not to make light of it, it is a lot of pain for a lot of people. But yeah, it's unbelievably the negative numbers we are going to go through at the moment.
Oh yeah, well, if you think about it, I don't know how many years it had been, but I think one of the last big economic updates I was at, I think it was, we had gone 28 years, without a recession or some ridiculous number like that. And I just looked at people and I just said, Jesus, the next 28 years are not going to be like the last 28 or 27 or 26 or however many it's been. And there is, if you think about it, there is literally a generation of people who have not known, and they're working right now in their working lives, who have not known any true economic hardship. And this is going to be a major shock, I think, to many of those people. So I don't know if you have any advice on, or would like to offer any advice on how younger people, millennials and stuff, should deal with this situation, or maybe how they should view it. If you do, I'd love to hear it.
Look, I don't have a lot of advice other than, and again, unfortunately, it is the nature of this shock is that the younger people are particularly negatively affected. So it's been those services and the hospitality areas that have been most negatively affected. So, our younger workers, many of them are younger workers, have been most negatively affected. All I can say in terms of this, we do know there's an end point, and that this is a virus-driven downturn. And when we do get a vaccine, again, the experts suggest within 12 months we will probably be able to get a vaccine, and/or herd immunity will have been built up so that we can go back to normal and learn to live with the virus. That there is an end point. So recessions are terrible. I guess what I would say, and again from also investors, there's a lot of investors that have never seen a serious recession or a bear market, and I think that's been reflected globally in the speed with which we've had equity markets rebound, and that these things can drag on a little longer than you expect. You don't just quickly bounce back because there's a lot of secondary effects that kick in. But they do end, they do end. And it's often, it's always just when you think things can, and again, from an equity point of view, just when you think you want to throw in the towel and it's the absolutely worst, you see no upside, that's when the markets bottom. It's when that final retail capitulation is when the markets bottom. But going back to younger work, I don't have, I feel, for sort of foolish trying to offer anyone advice in this sort of situation, because it's it is a pretty devastating situation where we are out of work in that hospitality area. I mean, I guess the upside also is that the government have bent over backwards to provide some payments, with the job seeker payments. So we are kind of putting the economy in hibernation. So unlike previous recessions, the income support available this time around is somewhat more generous, but again, it's still not a great situation, to be fair.
And I agree. It's this is probably once in a generation sort of thing for many people, and they'll think back to this time and go, "Wow, where were you when the COVID virus torched our economy?" I wanted to maybe move into a conversation now about interest rates, because we are, you want to talk about historical anomalies. Like, we are, I think, at a point where interest rates have never been lower in Australia, and you could argue that around the world.
Yes.
So there's probably a couple questions here. First of all is, do you see us going into negative interest rate territory? Let's open with that. Do you think that's a possibility here in Australia?
In terms of the RBA cash rate, I mean, it's at 0.25% now. No, so short answer, no. I don't think Japan and Europe tried negative interest rates, and basically it didn't really do much. And actually, if anything, it hurt their banking sector. So I think the RBA has been pretty adamant that they don't see any real benefit of going negative. Now, the only reason I think, and even in the US, I think the Federal Reserve Chairman Powell has come out sort of saying they don't see a case to go negative. So I don't think negative rates really help. The only way at which it helps is effectively, I see it as more of a competitive currency sort of thing. If a country wants to sort of support its economy, one way it can do it is to try to have a really cheap currency to boost tourism. And so that's what Japan and Europe tried to do. But I mean, if everybody tries to do that, it becomes self-defeating. And so that's why, I think hopefully we don't go down that path, because, if everyone did do that, it wouldn't help their currency, and all it would do is probably create even more of an asset price bubble, be it through equities or actually one thing we haven't mentioned is gold, which is holding up pretty well at the moment. But if central banks do go down this negative interest rate path, again, I don't think the RBA will. The Bank of New Zealand, for example, is talking about it. So there's one who are now flirting with negative rates. Gold is one that would benefit us if we go down that path. So going back to your very earlier question about ways to be defensive, gold is an interesting type of exposure in this environment of very low rates and central banks, potentially taking rates negative. But short answer, no, I don't see the RBA. It will go kicking and screaming in that direction, and only do it if other central banks have already done it, and just do it to basically stop our currency going up. If other central banks have cut their rates to sub-zero.
Well, they certainly have a number of levers they can pull beyond, just cutting the already put the last 0.25, of rates of cutting that. There's a number of other levers they can pull. But thank you for segueing into gold, because I did have another question from Judy, which was, where do you see gold going? So you kind of touched on that already, but if you could elaborate maybe on whether you see the gold price continuing to benefit from this low interest rate environment, which I suspect, I don't want to put words in your mouth, but you could elaborate on this. Do you see this low interest rate environment, first of all, continue to perpetuate for the foreseeable future, being 3 to 6 to 9 months or whatever? And then, what do you think will ultimately happen to the gold price?
Well, I think low rate. I think the RBA. Central banks around the world will keep interest rates where they are, like basically rock bottom zero levels, at least for a year. So, they'll hold them. And the thing is, this has pushed inflation even. Central banks already had inflation lower than they would like, and now this crisis has made inflation even lower. So they'll be very, very slow in raising interest rates. And in fact, one of the reasons I'm positive on gold is we may see more talk of what's called yield curve management, whereby, and again, the RBA has already done this, where they basically said, we'll buy as many government bonds as we need to keep the yield on 3-year government bonds no more than 0.25%. The Bank of Japan did it a few years ago, where they basically targeted the 10-year bond yield at 0. So they said, we'll buy as many bonds as we need to have a 0 yield on Japanese 10-year government bond yields. Now, what we're seeing with this crisis is obviously massive fiscal stimulus, massive budget deficits, a lot of debt being issued this year and next year. And to the extent there's any upward pressure in bond yields over the next year because of that huge issuance, you might see more central banks going down this path of targeting bond yields and saying, we're going to put a ceiling on how far bond yields can go up. And effectively what that means is printing money to buy bonds. It's debt monetization. So in that environment, that's where gold can do really well. You've got very low interest rates, you've got a lot of liquidity being pushed into the system, and gold doing very well. So so again, if equities sell off, I think gold will be, it may have a few initial ructions, but generally gold, I think, will push on. And then next year, with interest rates staying quite low, and certainly if equities haven't had a V-shaped recovery, but they're sort of moving up, but not by any great shakes, I think gold will attract interest. So and again, beta shares, of course, has a few exposures in that area, but so again, it's definitely easy to get gold exposure, through gold bullion, but even buying gold miners is another way of doing it. You can get exposure to gold mining companies.
Yes, I'm very familiar with the miners ETF. I've used that from time to time to get exposure to the gold markets. It's done really well, actually, in the last few months, with the gold price rising in Aussie dollar terms, and it's had a bit of a bull market itself. I wanted to circle back to some terminology you're using, V-shaped recovery, U-shaped, etc. I talk about this a lot, and I've been saying to my clients, we're not going to have a V-shaped recovery. Like, they are really gunning for that in the U.S. They're trying to talk about it. There's FOMO, there's all this stuff, and they're trying to make it happen, but I just cannot possibly see how that could be the case. So what sort of shape recovery do you actually think we're going to end up having?
Look, it'll probably, I'm actually settling on a W-shaped recovery. So the way that works is you get a very weak Q2 GDP number. So I guess let's think about it in terms of GDP growth. Now, just with some moderate recovery, if we open up restaurants and cafes and allow people to sort of travel again, at least within the states, you're going to get some bounce back in GDP in Q3. So that'll be positive, and so that's your bounce back, and then even in Q4. So we won't get the sharp negative decline. So we'll get a sharpish bounce back in Q3, but then Q4 being quite moderate. In fact, and again, if we get a second wave of the virus in the US or in Europe, you could actually then get a negative Q4. So we actually relapse. So that's where you get the sort of W. And again, then eventually you get the recovery once the vaccine is in place and or herd immunity has been built. And that's when you get the decent recovery. So I think it's going to be a rocky path in the short run. But I agree with you. I call them the V-shapers. The idea that we can get back to normal, with very soon. The problem is that even if you the two problems with opening up everything, going back to normal, is a very high chance of a second wave, in which case you need to close down again. So that won't basically last very long. And secondly, even if you did open up and there wasn't a second wave, I think we'll see consumers and businesses themselves being quite cautious in spending. And that will drag on for a while, because there'll be uncertainty about a second wave, and even it's hard. Imagine being a business trying to make investment plans 1 year ahead, knowing that any given moment the virus could re-erupt and governments could shut down the economy. That's a hard environment to plan and basically have massive investment programs. And so that's why you can't get a V-shaped recovery in that situation, because even in the best case scenario, the mere fear of a second wave will cause businesses and consumers to be quite cautious. And I'm just thinking, I actually travelled into work the other day. There's only 20% of people on trains at the moment, right? But we're in Sydney, and if someone's coughing, a few seats away, you're kind of nervous, And imagine being on a pack. You can't imagine having a packed train again anytime soon in Sydney, because being back to normal in Sydney would envisage packed trains, basically cheek to cheek, because we don't have a lot of train capacity anymore, and that is just you just can't foresee that in a winter without a vaccine. So that's the sort of situation.
And that's and I wanted to circle back around to earnings and all that sort of thing. So you've just described a situation that I've been, a story which I've been sort of sharing with my clients and saying to them is, we're not going to have a V-shaped recovery. If anything, we might get a bounce. It'll be a bear market bounce, and then we'll have some sort of resumption of the bear market. But there's so much uncertainty out there, which is really, I think, the message that you've just given, is that a lot of businesses are going to be very fearful about reopening and going to full capacity and bringing on the team that they had previously and all that sort of stuff. And it's going to have residual effects in the economy for some time. And so I wanted to just come back to earnings, because, we've started to see some of the corporate earnings come back poorly. Banks are, again, we mentioned that earlier, are already saying that they're anticipating weaker earnings. But are there any other segments of the economy that you're seeing right now that are going to certainly have that massively slowing earnings, and maybe haven't yet been priced for that in the market?
Look,
in other words, any areas of concern that you see?
In the US, they have a quarterly earnings cycle. So earnings are very much front and center quite regularly. Whereas in Australia, we have this 6 monthly earnings cycle. So we can go months where, earnings don't get a lot of attention. And so we're actually in this period at the moment where the earnings downgrades are taking place, but they're not getting a lot of attention. And what we're seeing, and not helped by the fact that what we're seeing in Australia and also globally is companies no longer providing guidance. They're saying things are so uncertain that we can't provide you a forecast of earnings 6 months down the track. And usually that's what analysts base their own forecasts on, and then they might, revise it up or down relative to what companies. So all the top 200 companies typically provide some form of guidance. That's like all but disappeared at the moment. So there is a lot of, haziness really in terms of the earnings outlook. But what I can tell you, groups like Bloomberg, Thomson Reuters, they do compile analyst earnings expectations. So there are survey-based measures of earnings out there. And so, for example, just in terms of Australia, before the virus hit, and even this was optimistic, we're expecting pretty flat earnings for calendar 1920. This is overall earnings for ASX 200 companies. That's now been revised down to minus 20%. So now expect earnings this financial year to decline by 20%. So that's been going on in the background. Now, the bad news, I think that's probably not enough. I think it's probably going to be 30 to 50% when all is said and done. And again, that's not being factored in at the moment, but it will be factored in. And the same case in the US, where they're looking at a 20% decline in 2020 earnings at the moment. That's what analysts have penciled in. But it's probably going to be, 30 to 40%, if not 50% decline, given the severity of the downturn. So earnings are quite opaque, but those that, look at the data, have access to the data, are noting that, and as I'm doing that, they are falling. I mean, they are falling. It's not been getting a lot of attention. And meanwhile, that's why price to earnings, talking about valuations in the markets, when earnings come down, the price to earnings ratio goes up, even if the share price doesn't change. And so what we've seen in the US, for example, even in Australia, is that, well, let's take it the US. The US is now trading at the same price to earnings ratio as it was before the virus, because the market's declined by about 15% net after the decline and the recovery. And that's about what earnings so far have fallen by, the forward earnings measure. So it's quite remarkable that the market is still trading a very high PE ratio. So again, that's where the vulnerability, I think, for the market is that earnings are going to fall. You know, nothing the central banks do or governments do is going to stop corporate earnings falling and probably remaining quite subdued for a time. And that's got to eventually be factored into the share market. Otherwise, the market will be trading at a very high valuation, and an unsustainably high valuation. But going back to your original question in terms of that, I mean, yeah, look, there's not a lot of clarity. You know, there's very little clarity. I mean, it's fair to say that retailers, you know, listed property, I mean, that's been another one. Listed property in Australia typically is seen as a more defensive exposure. You know, if equities sell off, landlords will still get their rents typically, whereas this time, again, given the nature of the shock, you know, it's been a massive shock to retailing, massive shock to restaurants. Listed property, commercial property, have actually fallen harder than the market overall. So that's an area where, you know, there's a lot of, you know, probably downgrades to come that haven't been factored into the market. Resources, meanwhile, holding up. So again, you'll find that volumes of iron ore prices have held up, and you know, China is still demanding our resources. So that might be a relative a source of strength in our market, where elsewhere things would be quite you know, quite subdued, and even more subdued than people generally imagine, because it's not being talked about.
No, it isn't. And you know, everything you've just sort of espoused is gold, because it's the feeling that I've had about corporate earnings in Australia. And I didn't realize that we were only on a 6-monthly cycle. I thought we at least got things quarterly, but it's interesting that yeah, I just don't think any of that really has been properly priced into the markets yet. And one of the things we are seeing in the US is we've just gone through a reporting cycle in the US, and earnings are down about 7.5% so far this year. And so it's and the market still seems to want to levitate. You know, I just think this is crazy. It's interesting about the REITs, because the government has really been a big influence. The heavy hand of government has been a big influence in this crisis. We've seen that with you know, what you've described, which is the you know, the government saying to landlords, you can't just turf people out, and there's a kind of a moratorium on being able to take action, and they've extended the rules around I forget the name of it, but you know, doing a statement of claim and these sorts of things. So I do have some questions about the government, and you know, I guess they're handling how they're going to repair the government balance sheet. I think ultimately is the question Judy is asking here. Is the government balance sheet's going to blow up? And we've seen that already in the U.S. They're up to, I don't know, $6.5–7 trillion now on the Fed's balance sheet. I don't know what our Reserve Bank's balance sheet looks like at the moment, but surely it will have expanded. How do you maybe if you could just comment on that and just position that in the overall context of what it's going to do for the Australian economy and recovery?
Well, I mean, I guess there's two balance sheets. There's the government one, and there's the Federal Reserve balance sheet, well, the central bank balance sheet. I mean, I'm not too worried about our central bank. We haven't done as much as the Federal Reserve has. Like, we've expanded our balance sheet, but we haven't needed to do as much buying, I think, as the Feds have done. So their balance sheet has expanded, and I'm not that worried about the expansion of the RBA balance sheet per se, to, you know, keep a lid on yields and provide some support to the corporate sector, just to prevent corporate bond spreads blowing out too much. Therefore, you know, good companies that can still refinance at reasonable rates. And again, in better times, I'll basically sell that debt back into the private sector and wind down their balance sheet. And we saw that with the GFC, where the balance sheets expanded. They gradually started reducing that. They didn't reduce it as much as they wanted, and as a result, it's now blown out again. So the challenge will be down the track. The budget deficits are another, I think, a trickier one. And our budget, I mean, look, we're thankfully starting from a position where net debt to GDP was pretty low, around 15% or so of GDP. Now, that'll probably widen out to, say, 40% of GDP. So our net debt to GDP will double, but 40% of GDP by global standards is still pretty low. A lot of the fiscal stimulus that we've got this year, and again, so our budget deficit will blow out next year to about 10% of GDP. But a lot of the stimulus is one-off payments. So again, the deficit itself will naturally contract because we won't be paying that JobKeeper payment again, next financial year. So it's $130 billion over 6 months, and then we won't spend that money again. So it's not a recurrent spending, which is important. So there will be a natural correction back in the deficit. And net debt is what it will be high. We used to pride ourselves on having low net debt to GDP. We will still have relatively low debt by global standards, but you couldn't say it's low. But it'll definitely be manageable. The other thing is that assuming inflation stays low, bond yields stay low, debt of that magnitude should be pretty easy to finance. I don't think there are any sort of financing issues. And again, central banks will be there buying up some of them if they need to, at least in the short run, to keep a lid on bond yields. So we'll get through this. I think the government may decide to revisit some tax measures. Some things like negative gearing, even franking credits. These sort of issues, and I'll throw that out there because, as they say, some people, some politicians say, don't waste a crisis. Don't waste a crisis, and so this may be a time to implement some unpopular things in the name of budget repair that they wouldn't otherwise, had the stomach to do. So you might see limits on negative gearing going forward, or caps on the extent to which you can claim franking credits. Not being talked about now, but maybe next year when the government will have a more, will probably need to do things to put a lid on the budget. That's when they can come back in. We'll see how that plays out.
And I've had just on the whole government and what they're doing and how they've responded to this crisis. I've had a question from Victor. He's just asking, is the Australian government doing enough for the industries that have been affected by the pandemic? So any thoughts on that? I mean, I think they've been doing a pretty good job, really. They responded fairly quickly in that, but what are your thoughts on that?
Look, I think they've done as good a job as you possibly do. You can't shut down a big chunk of the economy and have no one have any pain. And so some companies have lost revenue, and to the extent they need financing, they're getting financing. But at the end of the day, I mean, that can only go so far if the shutdowns extend. So I'm not sure what you can do apart from what they've done, providing income to people who've lost their jobs. I mean, the other thing, eventually go down the path of bailing out companies, but I mean, that's just going to be inordinately expensive. So I think what they're trying to do is companies that need financing to get them through this, to ensure that financial markets are functioning, and so people can still get access to credit and financing, short of bailing out every small business in the country, because that would just be basically, if you're a small business and you can't operate, unfortunately, you're probably going to have to shut down, close shop, and then, look to reopen again later, rather than, there's no point giving you money to stay open because there's no customers.
I think that's called being in a zombie economy, isn't it? Like, this is the thing that people forget about a business cycle, right? Is you have to have it. You have to.
I agree with you. I think the government is doing as much as they possibly can, and the Reserve Bank. There's always going to be areas that want to do more. But take international travel, for example. You can't have an international travel package when there's no international travel. What can you do?
Yeah. Okay. Well, I have, first of all, thank you so much for your time today. It's been a fantastic, I'm getting some great comments here. People are learning heaps from our conversation that we're having. I want to just close off with one final question. And I may be opening a can of worms here, but we'll be respectful of your time and everyone else's time. and try to finish on time. And that is around China. I've been having some conversations with clients. China seems to be now they've sort of been caught out bullying a lot of countries. They've been caught here in Australia trying to influence politicians, and they're trying to buy all of our stuff, and all of this. And so I'm deeply concerned personally about a number of things in Australia: security over food, water, oil, all of this stuff. And I know it's a big, broad question, but do you have any concerns over China and their influence and what they're doing, and how is that factoring into anything you're thinking about in terms of Australia? So the China question.
Yeah, the China question, it's a big question. Look, I will start off by saying this is something I've been saying for a number of years. Longer term, I'm quite bearish on China. I mean, I think China is still a one-party state. It's still transitioning from a low-cost manufacturing to being a bottom-up, service-orientated, entrepreneurial type economy, which eventually you do need to deregulate a lot more than they're doing. So I think the political and economic requirements of China are becoming increasingly at a sort of tension, and they're sort of resolving, sort of playing nationalism globally as a way to sort of still retain their local popularity. But I just worry about the longer term. I think longer term there's going to be some major changes in China, which means that we can't rely on China being this strong juggernaut of an economy forever. So we do need to diversify away our reliance on China to areas like India, Indonesia, Vietnam, some other emerging markets. So I think that's so that's point one. Point two is I think in a way China, you're right, China is trying to, bully, I guess, not only Australia. I mean, I think Chris Uhlmann from the Channel 9 is very on top of this. Anyone who follows him on Twitter, he's pointed out that China is bullying a lot of countries, to try to say, hey, look, we don't mess with us because we can disrupt our trade with you, or you're going to upset our relationship. But I actually think we're now starting to look through that, basically call China's bluff. And I think that's been the anger over the virus. I mean, has now meant that it's politically okay to sort of stand up to China, not only in Australia but around the world. And I think what we may see that at China, we're going to call their bluff essentially. And again, let's not forget, China is a member of the World Trade Organization. So it can't, in theory and legally, just block exports because it doesn't like something we've said. It's not part of the WTO, and we could actually take them to the WTO ourselves. So I am worried about it, but I actually think in a way the silver lining of all this crisis is that it now may mean that we stand up to China in a way that we weren't prepared to do in the past. And I think we will see changes in that regard going forward, which I think is a very positive development. And I definitely share with you all of the concerns you've raised.
And that on that note, David, I want to say thank you so much for joining me today for this conversation. I hope we can do it again at some point in the near future. Thank you to all the questions we had today, some really good ones that have come through. And that China question was from David, again, David Cook. So thanks very much for all of that. And David, I hope we can catch up in person at some point soon and have a conversation. So once again, thanks so much for joining us. And until next time, everyone, I'm PJ Patterson of Keystone Financial. Take care.